Tether. Love it or hate it, it's the backbone of crypto liquidity. With over $144 billion in circulation, USDT is the most traded asset in the entire crypto ecosystem, more than Bitcoin, more than Ethereum. It's the stablecoin that traders rely on, institutions quietly accept, and critics loudly question. Accusations have followed Tether for years, claiming of market manipulation, unbacked printing, and regulatory dodging. And yet it remains standing, central to over half of all Bitcoin trades globally, and deeply embedded in both centralized and decentralized platforms. In this video, we're going to unpack what's fact and what's speculation and what really matters. We'll break down the historical claims that USDT has artificially inflated Bitcoin's price, examine the real threats facing Tether today, assess their likelihood, and walk through the potential fallout, not just for Tether, but for the entire crypto market. Because whether you're a seasoned investor or just getting started, understanding the role and risks of Tether is critical. Let's start with the manipulation claims. For years, critics have alleged that Tether, the issuer of USDT, has been manipulating the price of Bitcoin. The basic claim is this: Tether issues unbacked USDT during key market downturns, uses it to buy Bitcoin, and artificially props up the price. This benefits their reserves, their affiliated exchange, Bitfinex, and creates an illusion of organic demand. The most cited piece of evidence comes from a 2018 paper by Griffin and Shams, which was later updated in 2019, where they found that more than half of Bitcoin's rise in 2017 could be tied to USDT issuances during moments of weakness in the market. The paper argued that just one address linked to Bitfinex was responsible for most of the suspicious activity. Now, it didn't stop there. A 2021 study found that Bitcoin returns were consistently higher in the 24 hours surrounding large USDT issuances. Another study in 2022 showed that even mentions of new USDT minting on Whale Alert, just the tweets themselves, correlated with price increases. And it wasn't just academics. A 2018 Bloomberg investigation found that small USDT orders on Kraken were disproportionately moving the market. Even today, in 2025, posts are going viral on X claiming that the recent $4 billion in USDT issuance in July helped lift Bitcoin by several $1,000s, suggesting that this kind of behavior is still happening. Now, terms like ghost bids and leverage spot pumping are getting traction again. So, what the heck does Tether have to say about this? Their CTO, now CEO, Paolo Ardoino, has always denied the manipulation claims. He says that USDT is only issued when there is real customer demand, and that the market is simply reacting to large inflows. Tether and Bitfinex also dispute Griffin and Shams' findings. They claim that the data used was incomplete, and the conclusions are based on correlation, not causation. But regulators haven't ignored this. In 2021, the CFTC fined Tether $41 million for misleading the public about its reserves. Turns out that from 2016 to 2018, only about 27% of its USDT supply was actually backed by fiat. That same year, Tether settled in the New York Attorney General's office for $18.5 million. The case revealed that Bitfinex had borrowed $400 million from Tether's reserves to cover losses without disclosure. And in 2022, a New York court ordered Tether to produce detailed documents about their reserves in an ongoing lawsuit that's still unresolved today. So here's where it gets circular. Tether currently holds about 82,000 Bitcoin, worth $4.7 billion as of August of 2024. That's 2.91% of its reserves. If Tether is minting USDT and using it to buy Bitcoin and then using that Bitcoin as part of its reserves, that creates a feedback loop that looks suspiciously close to a Ponzi structure. Now, whether that's actually happening is still unclear, but the design certainly invites concern. But still, we need to be honest about the data. Most of the research draws on correlation, not direct causation. Bitcoin tends to rise when new USDT enters the market. But we cannot prove that one is causing the other. It might be demand driven or it might be coordinated buying. The bigger problem is transparency. Tether doesn't provide full audits. Its reserve reports are unaudited and don't show exactly how and when its reserves shift. That opacity is what keeps the rumors alive, and in a market that runs largely on sentiment, sometimes that's all it takes. Now let's talk about the threats to Tether's stability, because even if claims of market manipulation are still debated, the structural risks are very real. We'll look at two categories: the threats coming from centralized platforms and how decentralized systems respond very differently. So first, the centralized threats. We have global regulatory crackdowns. The biggest pressure is regulation. In December 2024, the EU's MiCA framework went into effect. It requires stablecoins to maintain a one-to-one backing, submit to regular audits, and register as licensed electronic money institutions. Tether doesn't meet those standards, and as a result, Coinbase delisted USDT in the EU. Binance also halted USDT spot trading for European users. Kraken put it in sell-only mode, and these aren't minor moves. Europe makes up around 10 to 15% of global crypto volume. Meanwhile, in the US, Tether holds over $100 billion in treasuries. That puts it squarely in the sights of the SEC, the CFTC, and even the OFAC. These agencies could easily make moves against Tether, especially if allegations of AML violations or misrepresentations hold up. We've already seen what that looks like. In 2023, $225 million in USDT reserves were frozen during a trafficking investigation. That's not theoretical. That actually happened. Another threat to Tether is loss of market confidence. Tether's peg depends on people believing that every USDT is redeemable for $1, but that belief has been shaken before. Back in 2017, users couldn't withdraw funds. In 2018, Tether lost its auditor. In 2022, after the Terra USD collapse, USDT briefly dropped to 96 cents. Now today, Tether claims to hold $118.4 billion in reserves, with over $5 billion in surplus, but with no full public audit, doubts linger. A scandal, or even just a well-timed rumor, could trigger a digital bank run. Yet another threat is widespread exchange delistings. So far, the regulatory impact has been regional, but what happens if major non-EU exchanges like Binance Global or OKX come under similar pressure? Binance alone accounts for a huge portion of global USDT volume. If exchanges worldwide began delisting Tether, it would break key Bitcoin and USDT trading pairs and drain liquidity across the board. We've already seen what happened when Coinbase delisted USDT in Europe. Extrapolate that globally, and it's a serious liquidity shock. Another threat could be technological or operational failures, although this one's not likely. Tether has survived hacks before, like the $31 million theft in 2017. It's also frozen stolen tokens when needed, such as a $33 million tied to the Poly network hack in 2021. But the risk is still there. If custodians holding Tether's reserves, especially treasuries, fail, or if a smart contract exploit hits one of the blockchains where USDT is active, trading could be halted across multiple exchanges. And unlike with DeFi, you can't just route around centralized infrastructure. It locks up fast. So now let's flip the lens and look at how decentralized platforms respond in these scenarios. Should come as no surprise that decentralized systems show more resilience. So let's start with regulation. Even if centralized exchanges are forced to delist USDT, decentralized platforms like Uniswap or Curve continue to operate permissionlessly. There's no gatekeeper, no jurisdictional ban can fully shut them down. We saw this after the EU delistings. DeFi trading in USDT barely skipped a beat, especially in Asia and emerging markets where most volume occurs. Users simply turned to decentralized alternatives. Another one is loss of market confidence. In DeFi, the priority is liquidity, not ideology. Even after Terra's collapse, USDT liquidity pools held strong. Users kept using it because it was available and useful. And in DeFi, users make their own risk assessments. You don't need a central authority to tell you what to do. Exchange delistings, they are irrelevant in DeFi. The whole point of DEXs is that no one can delist anything. If there's demand for USDT, people will provide liquidity. There's roughly $10 billion in decentralized USDT liquidity right now across protocols like Uniswap, Curve, and Aave. That infrastructure doesn't vanish with regulatory pressure. Tech failures? Well, DeFi has redundancy. Tether operates on over 12 blockchains, so even if one chain faces issues, users can shift to another. DeFi platforms are already integrated with these multi-chain versions of USDT, meaning the failure of one doesn't crash the whole system. That's decentralization at its finest. Plus, in many DeFi protocols, governance can respond quickly. MakerDAO, for example, can vote to rebalance collateral or replace USDT with another stablecoin if needed. So while the centralized world faces very real threats, regulation, confidence shocks, delistings, the decentralized world has built-in escape hatches. It's not bulletproof, but it's a lot more anti-fragile. So coming up next, we'll walk through how likely these different threats are and where the biggest vulnerabilities actually lie. To assess how real the threats to Tether actually are, it's helpful to break them down by type and assign a realistic probability to each, centralized versus decentralized, based on current data as of August 2025. With the global regulatory crackdown, that's a low risk, a 10 to 30% chance maybe. On the centralized side, we've already seen the effects of Europe's MiCA regulations as of December 2024. Coinbase delisted USDT in the EU, Binance halted spot trading in March 2025, and Kraken has placed USDT in sell-only mode. These moves cut off about 10 to 15% of global USDT volume, but globally coordinated regulation is unlikely. Tether is too embedded in regions like Asia, where 60 to 70% of crypto volume still depends on USDT. Tether's reported $10 billion in profits and partnerships with firms like StableR and Quantos show adaptability, not retreat. In decentralized finance, a regulatory crackdown has almost no effect. DEXs like Uniswap and Curve are permissionless and borderless. Even if centralized exchanges delist USDT, users can continue trading on-chain without restriction. That alone significantly lowers the global risk of a full-scale ban. Another one is loss of market confidence, another low probability, 10 to 30%. On the surface, this seems like the biggest threat. No audits, past scandals, a long history of skepticism, and yet Tether keeps growing. As of August 2025, reserves are reported at $118.4 billion, with $5.3 billion in excess reserves. That's a decent cushion in the event of redemptions. Despite persistent FUD, Tether hasn't broken its peg in a meaningful way since the brief depeg during the Terra collapse in 2022. In decentralized markets, users have shown they're willing to tolerate risk in exchange for liquidity. USDT continues to hold a central role in DeFi pools, and the lack of confidence among institutions has not translated into mass exits from on-chain platforms. Now let's look again at widespread exchange delisting. This one is very low probability of 0 to 10%. Europe has already shown us what delistings look like under MiCA, and it's largely been limited to the EU. The rest of the world, especially Asia and Latin America, continues to support USDT with no sign of reversal. As of mid-2025, USDT still accounts for roughly 80% of Bitcoin trading volume globally. On the decentralized side, DEXs are, yet again, unaffected. Even if every centralized exchange dropped USDT tomorrow, Uniswap, Curve, and Aave, for example, would still be able to provide liquidity and trading functionality. The next one we're going to look at is competitor dominance. This is a moderate risk, 30 to 50%. This is arguably the most realistic pressure point. USDC, currently sitting at $34 billion market cap, is fully MiCA compliant and expanding its presence in regulated jurisdictions. Euro-based stablecoins like EURC and EURAU are gaining momentum, although they still represent a small slice of the market, a really small slice, under 500 million combined. In DeFi, DAI and USDC are popular and seen as more transparent, but Tether still maintains a 70% market share. Even if competitors make gains, overtaking Tether completely will take time. Now let's look at technological or operational failure. This one is also very low, at 0 to 10% chance. Tether has weathered some serious storms in the past. A $31 million hack in 2017, the Poly network incident in 2021, and internal issues with Bitfinex. And yet, it has survived. Today, USDT runs on 12 blockchains, which spreads the operational risk and reduces the chance of a total failure. Even in the case of a chain-specific issue, USDT remains functional elsewhere. The decentralized advantage here is obvious. As long as any of those blockchains are operational, USDT continues to circulate. Now let's look at market-driven obsolescence. It's low, 10 to 30%. CBDCs and algorithmic stablecoins have been pitched as future replacements, but CBDCs like the digital euro or the ECNY lack USDT's global liquidity, and algorithmic models still face skepticism after Terra USD's collapse. The truth is, no alternative currently matches Tether's scale, speed, and penetration, especially in emerging markets. Now in DeFi, alternatives are evolving, but Tether's $10 billion in liquidity remains sticky. There may be gradual erosion, but not outright obsolescence anytime soon. Out of all possible threats, the most realistic is increasing competition from regulated stablecoins like USDC. Regulatory crackdowns and confidence loss are possible but limited in scope. Technological failure and widespread delistings are extremely unlikely. And while USDT may not be perfect, it remains too entrenched, especially in decentralized systems, to simply disappear. So, if Tether were to collapse or face a serious crisis of confidence, the ripple effects would be enormous. But the magnitude and permanence of that fallout would differ depending on whether you're looking at centralized or decentralized systems. Tether isn't just another stablecoin, it's the backbone of crypto liquidity. As of late July 2025, USDT holds around 70% of the global stablecoin market with $149.88 billion in daily trading volume. It underpins about half of all Bitcoin trading pairs, and its dominance is especially strong in Asia and emerging markets, accounting for 60 to 70% of all trading volume in those regions. For traders and exchanges, it's the de facto settlement layer. On decentralized platforms, USDT remains deeply integrated. Around $10 billion in Tether liquidity is deployed across DeFi protocols like Uniswap, Curve, and Aave. It operates on 12 blockchains, with 97% of that activity concentrated on Ethereum and Bitcoin Layer 2 solutions. Whether it's yield generation, stable trading pairs, or cross-chain swaps, USDT is still everywhere. Now, in the event of a collapse, whether from regulatory freeze, scandal, or loss of peg, the first shock would hit centralized exchanges. We could see a 20 to 30% drop in the overall crypto market, similar to what happened in Terra USD in 2022. Now, liquidity would evaporate across Bitcoin and Tether pairs, halting trading and causing widespread panic. Exchanges like Binance and OKX, where USDT is a dominant trading pair, would be forced to pause redemptions, widen spreads, or remove markets altogether. This would be particularly disruptive in Asia, which relies heavily on Tether for both retail and institutional flows. There would also be a crisis of confidence, not just in Tether, but in the idea of stablecoins more broadly. Institutional players, including the wave of new Bitcoin ETF investors who brought in over $2 billion in inflows in July 2025 alone, may start pulling back. But that vacuum wouldn't stay empty for long. Regulated stablecoins like USDC or emerging Euro stablecoins such as EURC and EURAU would likely absorb some of the volume, but they currently lack the scale and reach of USDT. The transition would be messy, fragmented, and expensive, especially for users in emerging markets who rely on Tether for cross-border payments and remittances. Finally, a Tether collapse would almost certainly trigger a wave of new regulations. Think MiCA, but global. While this might bring long-term clarity, it would also introduce short-term uncertainty and compliance burdens across the board. Now here's where the narrative changes. Don't we love this silver lining? Decentralized systems have a unique ability to absorb shocks that cripple centralized platforms. They're resilient. If USDT were delisted or frozen on centralized exchanges, DEXs like Uniswap and Curve would continue to offer USDT liquidity, sustaining its use in trading and lending. That's thanks to DeFi's permissionless structure, which allows anyone to provide liquidity or trade regardless of jurisdiction. Following a centralized collapse, many users would migrate to DeFi by necessity. Protocols like Aave could continue to support USDT collateral or yield farming, while newer decentralized stablecoins like DAI or even algorithmic options would gain traction. USDT's presence across 12 blockchains is also a huge advantage. Even if it were frozen or delisted on Ethereum, it could still circulate on Tron, Solana, or Avalanche. This multi-chain design acts as a shock absorber, ensuring that no single point of failure wipes out its utility completely. Now, more broadly, this kind of crisis could accelerate the adoption of free market stablecoins governed by DAOs like MakerDAO. It would be a proving ground for decentralized alternatives, and for many users, a wake-up call about the fragility of centralized systems. In the short term, weeks to months, we'd see severe market volatility, disrupted trading pairs, and liquidity gaps across centralized platforms, especially in regions like Asia and Latin America. In the medium term, over the next 1 to 2 years, regulated alternatives like USDC would likely gain market share. Euro stablecoins would become more prominent in MiCA-compliant regions, while new rules would reshape the global landscape. But in the long run, the decentralized ecosystem would adapt and even benefit. There's no permanent damage for DeFi. Instead, a USDT collapse would likely strengthen the case for decentralized finance, pushing the industry toward more resilient and transparent models. Now, one of the big unknowns is whether a Tether collapse would drive more users into central bank digital currencies, CBDCs. There's a possibility that governments use the event to promote CBDCs, particularly in emerging markets and Asia, where USDT is most used. But CBDCs come with their own baggage: surveillance, transaction restrictions, and lack of privacy. Many crypto-native users would prefer DeFi alternatives like USDC or DAI that preserve user autonomy. In short, while a Tether collapse could create an opening for CBDCs, it's far more likely that it would energize decentralized solutions and accelerate the shift away from institutionally controlled finance. There's no single consensus when it comes to Tether. Opinions on USDT fall into 3 broad camps: bullish, bearish, and somewhere in between. Supporters of Tether argue that the numbers speak for themselves. With a $144 billion market cap, $5.2 billion in profit in the first half of 2024, and presence across 12 blockchains, USDT remains the most liquid, widely adopted stablecoin in the world, bar none. From their perspective, Tether isn't manipulating markets, it's reacting to demand. Issuances are said to reflect user activity, not artificial price propping. They point to high demand on centralized exchanges, booming DeFi usage, and global utility, particularly in places where traditional banking isn't reliable. Supporters also highlight new partnerships like StableR and Quantos, which aim to bolster Tether's role in MiCA-compliant environments and future-proof its infrastructure. Now, in short, the bullish case is that despite its lack of public audits, Tether has survived regulatory scrutiny, market cycles, and waves of criticism, and continue to thrive because it's filling a real need. Critics, especially those on Twitter, take the opposite stance. Obviously, they argue that Tether is the ticking time bomb of the crypto market, a centralized issuer with no audits, a history of regulatory run-ins, and a potentially circular reserve structure that includes Bitcoin itself. They cite the 2021 CFTC fine, the 2022 New York lawsuit, and the revelation that Tether's reserves were only 27.6% fiat backed at one point between 2016 and 2018, as all of these are red flags for them. In this view, every new issuance is treated with suspicion. Posts alleging ghost bids, printed liquidity, and price manipulation go viral whenever Tether mints a large amount of USDT. The fear is that a sudden loss of confidence, whether triggered by regulation, a scandal, or a peg slip, could cause a systemic collapse akin to Terra USDT in 2022, only on a much larger scale. And then there's the more measured, practical view. This group acknowledges Tether's shortcomings, especially its lack of transparency, but also recognizes its central role in today's crypto economy. From this perspective, the risk isn't necessarily that Tether will collapse tomorrow, but that its outsized importance makes it a structural risk worth watching. They argue that Tether's continued dominance on centralized exchanges and deep liquidity in DeFi make it too big to fail, at least in the short term. But over time, growing regulatory pressure and demand for audit transparency could shift the market toward more compliant stablecoin options. In the meantime, neutral observers tend to hedge their exposure, using Tether where it's liquid, but avoiding over-reliance. They also advocate watching regulatory developments closely, including ESMA rulings, SEC or CFTC actions, and on-chain behavior like wallet flows and burn events. The story of Tether is layered with complexity, and it's far from over. The claims of Bitcoin price manipulation led by studies like Griffin and Shams, or viral posts about ghost liquidity may raise serious concerns, but they remain correlation, not definitive proof. Tether's lack of audits continues to fuel speculation, but so far the system hasn't buckled. Of the many threats facing USDT, competitor dominance from more compliant or transparent stablecoins is the most likely to shift market share in the medium term. Regulatory crackdowns or confidence shocks remain low probability but high impact scenarios. And technological failures, highly unlikely thanks to USDT's multi-chain design and its track record of recovering from previous incidents. Now, if Tether were to collapse, the fallout would be significant. A 20 to 30% market drop, broken trading pairs, and halted liquidity would hit centralized platforms hardest, especially in Asia and emerging markets. But decentralized systems like DEXs, multi-chain infrastructure, and alternative stablecoins are poised to keep trading alive. In a way, the Tether saga isn't just about one stablecoin. It's a stress test for the broader crypto ecosystem. It highlights the risks of centralized dominance and the importance of decentralized resilience. So whether you trust Tether or not, the takeaway is the same. Stay diversified, watch the data, and understand the infrastructure you're using. And if you want deeper, actionable insights like this, visit learningcrypto.com. We publish no-nonsense crypto education designed to keep you informed, sovereign, and ahead of the curve. Let's build toward a future where stability doesn't come from trust in a single company, but from transparency, decentralization, and self-custody. Thanks so much for watching. I'll see you in the next video.